Ladies and gentlemen, good day and welcome to the Q1 FY23 earnings conference call of ICICI Bank. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sandeep Bakhshi, Managing Director and CEO of ICICI Bank. Thank you, and over to you, sir.
Good evening to all of you, and welcome to the ICICI Bank earnings.
So sorry to interrupt. Your audio is coming in low.
Good evening to all of you, and welcome to the ICICI Bank earnings call to discuss the results for Q1 of financial year 2023. Joining us today on this call are Anup, Sandeep Batra, Rakesh, Anandya, and Abhinay. During the quarter, we saw continued improvement in parameters like the index of industrial production, travel and mobility, pickup in non-oil and non-gold imports, and bank credit. There are concerns arising out of the movements in inflation and interest and exchange rates, largely reflecting the uncertainties in the global environment. The government and the Reserve Bank of India have taken various steps in this regard. We will continue to monitor these developments closely. At ICICI Bank, we aim to grow the core operating profit in a risk-calibrated manner through a 360-degree customer-centric approach and by focusing on ecosystems and micro markets. We continue to operate within our strategic framework and strengthen our franchise, enhance our delivery and servicing capabilities, and expand our technology and digital offerings. Coming to the quarterly performance against this framework, first, growth in the core operating profit in a risk-calibrated manner through the focused pursuit of target market segments. The core operating profit increased by 19.4% year-on-year to 102.73 billion rupees in this quarter. Excluding dividend income from subsidiaries and associates, core operating profit grew by 21.1% year-on-year. The profit after tax grew by 49.6% year-on-year to 69.05 billion rupees in this quarter. Second, further enhancing our strong deposit franchise. Total period end deposits grew by 13.4% year-on-year at June 30, 2022. During the quarter, average current account deposits increased by 23% year-on-year and 2.9% sequentially. Average savings accounts deposits grew by 19.1% year-on-year and 4.4% sequentially. Period term deposits grew by 11.4% year-on-year at June 30, 2022. The liquidity coverage ratio for the quarter was about 127%, reflecting continued surplus liquidity. Our cost of deposits continues to be amongst the lowest in the system. Third, growing our loan portfolio in a granular manner with a focus on risk and reward. The retail loan portfolio grew by 24.4% year-on-year and 5.1% sequentially at June 30, 2022. Including non-fund based outstanding, the retail portfolio was 44% of the total portfolio. The rural portfolio grew by 8.4% year-on-year and was flat sequentially. The business banking portfolio grew by 44.7% year-on-year and 7.4% sequentially. The SME portfolio grew by 32.3% year-on-year and declined by 2.6% sequentially. The growth in SME and business banking portfolios was driven by leveraging our branch network, cross-selling to existing current account customers, and digital offerings such as InstaBiz and Merchant Stack. The domestic corporate portfolio grew by 14.4% year-on-year and 4.4% sequentially at June 30, 2022. The domestic loan portfolio grew by 21.7% year-on-year and 3.9% sequentially. The overall loan portfolio grew by 21.3% year-on-year and 4.3% sequentially at June 30, 2022. Fourth, leveraging digital across our business. We continue to enhance our digital offerings and platforms to onboard new customers in a seamless manner and provide them end-to-end digital journeys and personalized solutions. These platforms also enable us to do more data-driven cross-sell and upsell. Recently, we have further enhanced the open architecture-based features of InstaBiz. Merchants can now open a current account instantly and digitally on InstaBiz by using video KYC. Through Insta OD Plus, customers of any bank can avail an overdraft facility of up to 2.5 million rupees instantly on InstaBiz. We have seen about 1.2 lakh registrations from non-ICICI Bank account holders on InstaBiz till June 30, 2022. Recently, the bank launched a revamped One SCF, an integrated supply chain platform, providing corporate solutions, their vendors and dealers, with a one-stop solution to efficiently manage their working capital requirements. We have shared some details on our technology and digital offerings in the slides 18 to 28 of the investor presentation. Fifth, protecting the balance sheet from potential risks. The net NPA ratio declined to 0.7% at June 30, 2022, from 0.76% at March 31, 2022, and 1.16% at June 30, 2021. During the quarter, there were net additions of 3.82 billion rupees to gross NPAs, excluding write-offs and sales. The provisioning coverage ratio on NPAs was 79.6% at June 30, 2022. The total provisions during the quarter were 11.44 billion rupees, or 11.1% of core operating profit and 0.53% of average advances. This includes contingency provision of 10.50 billion rupees made on a prudent basis. The bank holds contingency provisions of 85 billion rupees or 0.9% of total loans as of June 30, 2022. Sixth, maintaining a strong capital base. The capital position of the bank continued to be strong with a CET1 ratio of 17.23%, Tier 1 ratio of 17.95%, and total capital adequacy ratio of 18.74% at June 30, 2022, including profits for the quarter. Looking ahead, we see many opportunities to grow the core operating profit in a risk-calibrated manner. In order to leverage these opportunities, we have reorganized our business teams. Cities with large concentrated market opportunities have been organized under city business heads, covering the full spectrum of ecosystems. We have also focused on strengthening the workforce by skilling and providing cross-functional opportunities. We'll continue to make investments in technology, people, distribution, and building our brand. Going forward, we will continue to operate within a strategic framework while focusing on micro markets and ecosystems. The principles of fair to customer, fair to bank, and one bank, one ROE will guide our operations. We focus on building a culture where every employee in the bank serves customers with humility and upholds the values of brand ICICI. We aim to be the trusted financial service provider of choice for our customers and deliver sustainable returns to our shareholders. I now hand the call over to Anandya.
Thank you, Sandeep. I will talk about balance sheet growth, credit quality, P&L details, growth in digital offerings, portfolio trends, and performance of subsidiaries. Balance sheet growth, Sandeep covered the loan growth across various segments. Coming to the growth across retail products, the mortgage portfolio grew by 22.3% year-on-year and 4.1% sequentially. Auto loans grew by 17.6% year-on-year and 5.2% sequentially. The commercial vehicles and equipment portfolio grew by 3.7% year-on-year and was flat sequentially. Growth in the personal loan and credit card portfolio was 44.7% year-on-year and 9.6% sequentially. This portfolio was 963.85 billion rupees or 10.8% of the overall loan book at June 30th, 2022. The overseas loan portfolio in US dollar terms grew by 7.4% year-on-year and 6.4% sequentially at June 30, 2022. The increase in the overseas loan portfolio was primarily due to increase in the India-linked trade finance book. The overseas loan portfolio was about 5.1% of the overall loan book at June 30th. The non-India linked corporate portfolio declined by 52.8% or about $513 million on a year-on-year basis. Of the overseas corporate portfolio, about 87% comprises Indian corporates, 6% is overseas corporates with Indian linkage, 4% companies owned by NRIs or PIOs, and balance 3% is non-India corporates. Coming to credit quality, there were net additions of 3.82 billion rupees to gross NPAs in the current quarter compared to net deletions of 4.89 billion rupees in the previous quarter. There were net additions of 7.24 billion rupees to gross NPAs in the retail, rural and business banking portfolio and net deletions of 3.42 billion rupees from gross NPAs in the corporate and SME portfolios. The gross NPA additions were 55 billion rupees in the current quarter compared to 42.04 billion rupees in the previous quarter. The gross NPA additions from the retail, rural and business banking portfolio were 50.37 billion rupees and from the corporate and SME portfolio were 7.88 billion rupees. There were gross NPA additions of about 7.55 billion rupees from the Kisan credit card portfolio in the current quarter. We typically see higher NPA additions from the Kisan credit card portfolio in the first and third quarter of a fiscal year. Recoveries and upgrades from gross NPAs, excluding write-offs and sale, were 54.43 billion rupees in the current quarter, compared to 46.93 billion rupees in the previous quarter. There were recoveries and upgrades of 43.13 billion rupees from the retail, rural and business banking portfolios and 11.3 billion rupees from the corporate and SME portfolio. The gross NPAs written off during the quarter were 11.26 billion rupees. The bank sold NPAs amounting to 0.13 billion rupees during the quarter on a cash basis. Net NPAs declined by 28.5% year-on-year and 4.4% sequentially to 66.56 billion rupees at June 30th, 2022. The non-fund-based outstanding to borrowers classified as non-performing was 36.7 billion rupees as of June 30th, 2022, compared to 36.4 billion rupees as of March 31st, 2022. The bank holds provisions amounting to 20.75 billion rupees as of June 30th, 2022 against this non-fund-based outstanding. The total fund-based outstanding to all standard borrowers under resolution as per various guidelines declined to 73.76 billion rupees or about 0.8% of the total loan portfolio at June 30th, 2022 from 82.67 billion rupees as of March 31st, 2022. Of the total fund-based outstanding under resolution at June 30th, 2022, 52.75 billion rupees was from the retail, rural and business banking portfolio and 21.01 billion rupees was from the corporate and SME portfolio. The bank holds provisions of 22.90 billion rupees against these borrowers, which is higher than the requirement as per RBI guidelines. Coming to details of the P&L, net interest income increased by 20.8% year-on-year to 132.1 billion rupees. The net interest margin was 4.01% in this quarter compared to 4.0% in the previous quarter and 3.89% in Q1 of last year. The impact of interest on income tax refund on net interest margin was 3 bps in Q1 of this year compared to 1 basis point in the previous quarter and in Q1 of last year. The domestic NIM was at 4.14% this quarter compared to 4.12% in the previous quarter and 3.99% in Q1 last year. The cost of deposits was 3.46% in this quarter compared to 3.48% in the previous quarter. Of the total domestic loans, interest rates on 43% are linked to the repo rate, 6% to other external benchmarks, and 21% to MCLR and other older benchmarks. The balance 30% of loans have fixed interest rates. Non-interest income, excluding treasury income, grew by 24.9% year-on-year to 46.29 billion rupees in Q1 of 2023. Fee income increased by 31.8% year-on-year to 42.43 billion rupees in this quarter, driven by growth across various segments, partly reflecting the low base in Q1 of last year. Fees from retail, rural, business banking and SME customers grew by 37.8% year-on-year and constituted about 79% of the total fees in this quarter. Dividend income from subsidiaries and associates was 3.47 billion rupees in this quarter, compared to 4.1 billion rupees in Q1 of last year. The year-on-year decline in dividend income was due to lower final dividend from ICICI Life, offset in part by higher dividend from ICICI AMC and ICICI Securities Primary Dealership. On costs, the bank's operating expenses increased by 25.3% year-on-year in this quarter, partly reflecting the low base in Q1 of last year. The employee expenses increased by 20% year-on-year. The bank had about 107,350 employees at June 30, 2022. The employee count has increased by about 7,250 in the last 12 months. Employee expenses in this quarter include an impact of 1.29 billion rupees due to fair valuation of ESOPs granted to all employees post April 1, 2021 as required by RBI guidelines. Non-employee expenses increased by 28.8% year-on-year in this quarter, primarily due to retail business and technology-related expenses. The technology expenses were about 8.5% of our operating expenses in this quarter, similar to FY23. The core operating profit increased by 19.4% year-on-year to 102.73 billion rupees in this quarter. Excluding dividend income from subsidiaries and associates, the core operating profit grew by 21.1% year-on-year. There was a treasury gain of 0.36 billion rupees in Q1 compared to 1.29 billion rupees in Q4 and 2.90 billion rupees in Q1 of the previous year. The total provisions during the quarter were 11.44 billion rupees, or 11.1% of core operating profit and 0.53% of average advances. These include contingency provisions of 10.50 billion rupees made on a prudent basis. The provisioning coverage on NPAs continued to be robust at 79.6%. In addition, we hold 22.90 billion rupees of provisions on borrowers under resolution. Further, the bank holds contingency provision of 85 billion rupees as of June 30th, 2022. At June 30th, 2022, the total provisions, other than specific provisions on fund-based outstanding to borrowers classified as non-performing, were 187.70 billion rupees, or 2.1% of loans. The profit before tax grew by 51.7% year-on-year to 91.65 billion rupees in this quarter. The tax expense was 22.60 billion rupees in this quarter, compared to 14.27 billion rupees in the corresponding quarter last year. The profit after tax grew by 49.6% year-on-year to 69.05 billion rupees in this quarter. The consolidated profit after tax grew by 55% year-on-year to 73.85 billion rupees in this quarter. Coming to the growth in digital offerings, leveraging digital and technology across businesses is a key element of our strategy of growing the risk-calibrated core operating profit. We continue to see increasing adoption and usage of our digital platforms by our customers. There have been 7.3 million activations of iMobile Pay by non-ICICI Bank account holders as of end June. The value of transactions by non-ICICI Bank account holders increased by 35% sequentially in the current quarter. The value of credit card spends in the current quarter grew by 12.6% sequentially and was 2 times the value of spends in Q1 of last year, driven by improvement in discretionary spending, higher activation rate through digital onboarding of customers, including through the Amazon Pay credit card, and diversification through commercial cards. The bank has issued more than 3.2 million Amazon Pay credit cards since its launch. During the quarter, we launched Campus Power, an online platform providing various banking solutions such as loans, bank accounts, foreign exchange remittances, and value-added services to the student ecosystem for higher education in India and abroad. The value of financial transactions on InstaBill grew by about 57% year-on-year in the current quarter. The value of transactions on our supply chain solutions, Corp Connect and Digital Lite, in the current quarter was 2.4 times the value of transactions in Q1 last year. The proportion of end-to-end digital sanctions and disbursements across various products has been increasing steadily. About 33% of our mortgage sanctions and 44% of our personal loan disbursements by volume were end-to-end digital in Q1 of this year. The bank has created more than 20 industry-specific stacks which provide bespoke and purpose-based digital solutions to corporate clients and their ecosystem. The volume of payment and collection transactions through API-based solutions in Q1 of this year was 3.7 times the volume of transactions in Q1 last year. Moving on to information on the portfolio, we have provided details on our retail, business banking and SME portfolios in slides 35 to 45 of the investor presentation. The loan and non-fund based outstanding to performing corporate and SME borrowers rated BB and below was 82.09 billion rupees at June 30, 2022, compared to 108.08 billion rupees at March 31, 2022. This amount of 82.09 billion rupees at June 30, 2022 includes 28.89 billion rupees of loans under resolution. The sequential decline during the quarter was mainly due to reduction in exposure to a borrower in the telecom sector and upgrades of a few accounts in the power and construction sectors. The details are given on slide 37 and 38 of the investor presentation. Other than one account in the power sector where resolution has been implemented as per RBI's COVID-19 resolution framework, the maximum single borrower outstanding in the BB and below portfolio was less than 6 billion rupees at June 30th, 2022. At June 30th, 2022, we held provisions of 8.61 billion rupees on the BB and below portfolio compared to 12.32 billion rupees at March 31, 2022. This includes provisions held against borrowers under resolution included in this portfolio. The total outstanding to NBFCs and HFCs was 699.72 billion rupees at June 30, 2022, compared to 686.32 billion rupees at March 31, 2022. The total outstanding loans to NBFCs and HFCs were about 8% of our advances at June 30, 2022. The sequential increase in the outstanding to NBFCs and HFCs is mainly due to disbursements to public sector entities, entities having long vintage, and entities owned by well-established corporate groups. The builder portfolio, including construction finance, lease rental discounting, term loans, and working capital loans, was 275.69 billion rupees at June 30, 2022, compared to 269.48 billion rupees at March 31, 2022. The builder portfolio is about 3% of our total loan portfolio. Our portfolio is granular in nature, with the larger exposures being to well-established builders, and this is also reflected in the sequential increase in the portfolio. About 8.3% of our builder portfolio at June 30, 2022 was either rated BB and below internally or was classified as non-performing, compared to about 9.5% at March 31, 2022. Moving on to the list of subsidiaries and key associates, the details of the financial performance of subsidiaries and key associates are covered in slides 49 to 51 and slides 70 to 75 in the investor presentation. The VNB margin of ICICI Life increased from 28% in FY22 to 31% in Q1 of this year. The value of new business increased by 31.6% year-on-year to 4.71 billion rupees in Q1 of this year. The annualized premium equivalent grew by 24.7% year-on-year to 15.2 billion rupees in Q1 of this year. The profit after tax of ICICI Life was 1.56 billion rupees in Q1 of this year, compared to a loss of 1.86 billion rupees in Q1 of last year. The gross direct premium income of ICICI General increased by 28.2% year-on-year to 53.7 billion rupees in Q1 of this year. The combined ratio was 104.1% in Q1 of this year, compared to 123.5% in Q1 of last year. The profit after tax grew by 79.6% year-on-year to 3.49 billion rupees in the current quarter. The profit after tax of ICICI AMC was 3.05 billion rupees in this quarter, compared to 3.8 billion rupees in Q1 of last year. The profit after tax of ICICI Securities on a consolidated basis was 2.74 billion rupees in this quarter, compared to 3.11 billion rupees in Q1 of last year. ICICI Bank Canada had a profit after tax of 7.2 million Canadian dollars in this quarter, compared to 5 million Canadian dollars in Q1 last year and 4.3 million Canadian dollars in the preceding quarter. ICICI Bank UK had a profit after tax of $3.4 million this quarter, compared to $2.9 million in Q1 of last year and $3.1 million in Q4 last year. As per Ind AS, ICICI Home Finance had a profit after tax of 0.4 billion rupees in the current quarter, compared to 0.17 billion rupees in Q1 of last year and 0.53 billion rupees in Q4. With this, we conclude our opening remarks, and we'll now be happy to take your questions.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Maru Kadajania from Edelweiss. Please go ahead.
Yeah, hello. Congratulations. Could you please explain the increase in employee expenses? Because there was a sharp increase. That's my first question.
Yeah, so Maruk, as we explained, we have added, if we compare over the last 12 months, we have added about 7,250 employees. Also, the ESOP cost, which was not accounted for in Q1 of last year, is getting accounted for, in Q1 of this year. That's about 1.29 billion rupees. And we would have the impact of, promotions and increments that would have become effective, in the current quarter.
Okay. So a large part of it is growth related as well.
Yes.
Okay. And my other question was on your yield. So if you see the yield on loans, it's kind of declined quarter on quarter. That's largely because of the foreign book.
No, so I think, as you know, the rise in interest rates is a phenomenon that started to play out only from June. So it reflects, the rates at which lending has been done over the last few quarters and the, relative maturity versus new lending in the book, because rates were quite competitive well into May as well. There would also be, if you recall, last time we had mentioned that there is some arithmetical impact between Q4 and Q1 because of the number of days. So if you look back historically also in Q1 versus Q4, the yield has been slightly lower.
Got it. Thanks. In general, how would the growth outlook pan out? as in that we are into a strong growth phase right now. But does the global scenario impact growth 6 months down the line, or is there resilient structural demand?
So I think currently, Maruk, if you look at general loan growth across the sector as well as for us and our peer banks who have reported, it has held up quite well. Although rates have started moving up, from late May, and there seems to be fair degree of resilience in demand in the typical segments in which banks like us operate. But we'll have to monitor this as we go along.
Got it. And I just have one last question, which is really on your bond portfolio. So you did make trading gains, and you did not have any mark-to-market loss. That's correct?
Yeah. So, Maruk, on our AFS portfolio, as we may have discussed in the past, we generally carry a very low duration. So, whatever mark-to-market, if at all, would have been there, would have been negligible. And we would have had some small gains on the equity side. So that has led to this small net positive. But even adjusted for that, we would not have had any material mark-to-market gains at all because of the low duration of our AFS portfolio.
Okay. Thanks a lot. Thank you.
Thank you. The next question is from the line of Manish Oswal from Nirmal Bang. Please go ahead.
Thank you, sir. Only one small data point. What is the size of the AFS book and the AM duration, modified duration of the book?
No, we don't disclose that on a quarterly basis.
Okay, sir. Thank you.
Thank you. The next question is from the line of Nilanjan Karfa from Nomura. Please go ahead.
Hi, thanks. Hope I'm audible. Going back to the yield question, would you have some walk in terms of the incremental loans that we do at the higher rate? Because the decline on a sequential basis, even after including the reasons that you gave, it's a little more. If you can just help us walk through that decline.
No, I think we already explained it that lending rates were pretty competitive, have been pretty competitive across segments over the last few quarters. So that will now start reversing out as the benchmarks pick up. And there would have been some, mathematical impact of the day count, which has been seen in the past as well. Beyond that, really, there is no other factor.
Okay. And so if the reasons continue like this, do you think when the back book reprices along with the reset debt, do you expect the reset to also be slightly muted?
No, the reset will be to the extent that the benchmark changes. So it will entirely reflect the change in the benchmark. There's no change in the spread.
Right. Okay. All right. The second one I wanted to just ask is on the SME portfolio. That's quite a, even though there's a sequential decline, I think the growth is quite robust. Could you help understand, which are the segments where you are seeing a lot of demand? And secondly, across both SME and corporate loan, could you share, what percentage is the working capital loan and how this has changed through this quarter? Because, the commodity prices have also been quite, volatile.
So I think if you look at our portfolio, we have been, quite consistently growing the SME portfolio for the last, 4 years or so. We had made a lot of changes in the way we approach this category of customers over the last 5 years in terms of our distribution, our credit underwriting, our portfolio granularity, and so on. And this is probably one of the portfolios where, the credit outcomes, so far, post-COVID, has been somewhat better than what we may have originally anticipated. So we are quite comfortable with growth across in this portfolio. One of the other things that we have done over the last 3 years is invested heavily in digital propositions for this segment of customers, and we have also seen fairly high increase in digital adoption in this segment. So those are the areas that have driven this growth. It is a mix of working capital and sort of term loans. I don't think that there is anything specific to call out in terms of increase in working capital requirements in this quarter as such, because the growth rates have been quite in line with what we have seen in the past, adjusted for the period of dislocation during the pandemic.
Right. Let me squeeze in a third one. If we look at the segmental disclosure, and while we obviously don't talk about how the equities are split between these businesses, but generally speaking, if you look at the profitability of each of these segments, which is the segment that you are seeing the profitability sort of jump quite a bit? Would you say that, for example, the corporate or the wholesale segment is actually doing a little better than retail? And do you think that's going to persist through the next couple of quarters?
No, I don't think so. I think the corporate segment, if you look at the improvement in profitability for what is reported in the corporate segment, I think part of that is due to a reduction in, actually a write back of provisions as recoveries. We continue to get recoveries out of past NPLs in that portfolio. On the retail side, of course, if you look at it on a year-on-year basis, there is a sort of multiple jump in the profit. On a sequential basis, I think a lot of the 75-80% of our cost base sits in retail. So the sequential increase in costs that we discussed earlier in response to another question would largely reflect in retail. And also, as we mentioned in the first quarter, we do see the seasonally higher addition to NPLs in the KCC portfolio, which was 7.55 billion rupees in this quarter, and the provisioning on that would also have would also form part of the segmental result. But I don't think in terms of long-term profitability trends there is anything to call out. And the last thing I would like to say is that we are increasingly trying to organize ourselves around ecosystem. So there is a lot of sort of how should I say it, while for basis regulatory requirements we would be reporting a segmental basis, but the way we are organized internally is much more around cross-functional teams and looking at particular customer ecosystems where these distinctions are quite blurred in that sense.
Right, Anindya. Thank you so much.
Thank you. The next question is from the line of Jay from B&K Securities. Please go ahead.
Yeah, hi sir. Good evening and thanks for the opportunity. First, sir,
if you can take the phone off speaker, please.
Sure.
Yeah.
Hello, is it any better?
Yes, sir. If you can speak a little close and little loud.
Yeah, hi sir. If you can share the duration of your term deposit, what could be the average duration of your term deposit? I mean, a ballpark number will also do.
We have not really given a duration per se. I think we do publish the sort of maturity pattern. I would say that we would have a significant proportion in 1 year plus.
Right. I think that gets distorted because 1 year plus would have the entire CA, and I don't know what percentage of SA would be sitting in either 3 years, 5 years. So specifically on term deposit, I mean ballpark, let's say how much of that would be let's say less than 1 year, or how much could be over 3 years or 5 years?
The retail term deposits actually across most banks, a lot of it is in the 1 year bucket that Anindya said. It is for the retail FD in particular, not the total deposits. A lot of it is in 1 year, and of course, we have been offering slightly higher rates in the longer bucket as well, in the 3 year bucket. So some of the deposits would have come in that bucket, but predominantly it will be, in the 1 year, 12 to 18 months bucket. And for all banks, it will be pretty similar.
Sure, understood. And just while we are on this, the distribution of savings, the current deposit will always be less than 1 year, right? It's fair to assume that. Let's say 90-95% of the CA in that maturity pattern would be sitting in less than 1 year maturity.
That is behavioral, no? So it will vary for the
It will vary, and it may not be consistent across banks as well.
All right. Okay. Second question is, sir, on your distribution strategy, I mean the branch strategy, we have been fairly calibrated over the last 3-4 years, maybe rightly so, because we have already, increased the digital offerings and digital services. How do you think that you may have to sort of rethink that approach for the next 2-3 years, considering the competitive landscape emerging, especially distribution strategy by the largest private bank?
No, so we have, we gave a lot of flexibility to our operating teams on where and how many branches they want to open. We have not imposed any restrictions. It is part of, the investment that needs to be made and managed within our overall PPOP framework. This quarter, if you see, we have after a long time added about 120 branches.
Right.
So we will keep, looking at that and adding as we need to wherever we see, opportunity to either, establish a presence in a growth market or deepen our presence in a high value market.
Right. No, so the question is similar, that could we see a higher branch addition pace versus what we have seen over the, let's say, last 2-3 years?
Yeah, I think we could, but that is, based on our own sort of growth strategy.
Understood. And last question, sir, is, even adjusted for KCC slippages, the retail slippages on a, compared to last quarter also look higher. Would you have any specific reasons apart from the KCC slippages?
So as we have been saying, for some time, I think in the granular portfolios like retail, business banking, SME and so on, we need to focus on the net slippage.
Right.
Similarly, in the granular working capital accounts, where there may be an NPL classification due to some technical reason, which then gets regularized. These types of accounts, to a large extent, tend to cure in a pretty short period of time. This is very different from the lumpy corporate type exposures, which once they get into the NPA bucket, there's typically a long delay till the recovery happens. So we would, really focus on the net number. And as far as the net number is concerned, we have been saying for some time that, of course, in the second half of last year, we had net deletion from gross NPAs, but that was due to, higher recoveries out of the stock of NPAs that had got created during the pandemic period. And we were expecting that the net additions we would start seeing positive, net additions from the current quarter, which is what has played out. Although I must say that, even the current level of net additions is, relatively low.
Right. Yeah, that's all from my side, sir. Thank you so much.
Thank you. Before we take the next question, a reminder to the participants, please limit your questions to 2 per participant. For any follow-up, may be requested to rejoin the queue. The next question is from the line of Nitin Aggarwal from Motilal Oswal. Please go ahead.
Yeah, hi. Good evening and congratulations on strong performance. I have 2 questions. One is around how sustainable are the recovery trend that we are witnessing over past few quarters? And in context to this, if you look at our provisions to PPOP guidance, and even including the contingent provisions, we are seeing a very benign run rate. So how do we see that? Any thoughts around this? And second question is on unsecured book. The PL and credit card both are doing very well, and the mix is now hitting 10.5-11% of the total book. And so how do you really see that? Any cap that we will look to have on the mix of unsecured assets? These are my two questions.
Yeah. So on the first one, I think, one is that I guess it sort of gives us confidence in our underwriting. And I think that the two things we must remember is that on the corporate side, we were anyway, even in 2019, 2020, coming off a very deep corporate cycle. So it is fair to expect that in the years after that, you would have a very benign kind of credit experience. In retail and SME, the portfolio has gotten, severely tested by COVID. And of course, we did see, higher NPL additions during that time. So now from here on, we will have to see how the mix, the gross additions and recoveries and so on evolve, and look at what kind of credit costs come through. But in terms of, what we are sort of planning over the long term, or what we are, our tolerance levels, or what we are trying to design the business to, we would, continue to look at that, 20% of provisions to PPOP. Sorry, what was your second question?
On the unsecured mix.
Yeah, credit unsecured. No, so, we, as you know, we have grown this portfolio primarily on the back of cross-sell to existing customers, or through very strong partnerships like Amazon, and by identifying sort of the correct profiles, even if they are new to bank, and the credit performance of these portfolios have been quite good, and so we have no plans to look at any cap, etc. as of now, because we don't see anything in the credit trends to warrant that.
Sure. Thanks so much.
Thank you. The next question is from the line of Ashish Sharma from Enam AMC. Please go ahead.
Yeah. Thank you for the opportunity, and congratulations to the team for a stellar set of numbers. So two questions, one on the credit cost. So we've seen that we have created another contingent provision in this quarter, but we've seen the peer bank sort of writing back the provision they made in relation to the COVID. So sir, some color on as to how we see the credit costs. Given our strategy of sort of creating contingent provision. And second question would be on the credit card portfolio. If you can just sort of give some color on the revolver book. Has it picked up? That would be helpful, sir.
So I think when we looked at this contingency provision on a prudent basis, clearly, as you would have seen the numbers in terms of the net additions as well as the net provisions, the numbers are very low. But at the same time, there are, potential headwinds in the environment, given what is happening on inflation and rates, and potentially a sharp slowdown in growth in major economies and so on. So that is why, given that, although the current trends are benign, we looked at, our portfolio and decided to create this, add to our contingency buffer to, strengthen the balance sheet, which is a key element of our strategic framework that Sandeep also spoke about. So that is how we looked at it. I think we'll have to see how, the credit cost trajectory evolves in future. On the revolvers, of course, compared to pre-pandemic levels, revolver rates had come down, and we hope that they would now start, moving up as spends also pick up.
Okay, great. Thank you. Thank you, Nindya.
Thank you. The next question is from the line of Hardik Shah from Goldman Sachs. Please go ahead.
Yeah, thanks. This is Rahul here. Just a couple of questions. Just on slide 36, the rating-wise mix that you've given, is it predominantly for the entire corporate and the SME portfolio? I mean, just wanted to understand what explains this swing from 36% in AA minus and above to 47.
Yeah, so this is on the non-retail portfolio, and as you see, the A and above bracket has remained broadly stable. There would have been some upgrades from the A family to the AA and above family. So that is a movement that would keep happening.
Okay.
But broadly, we would focus on say 70% plus being A and above, A minus and above.
Understood. And will it have sort of implication on yields also going forward in this portfolio then?
Not really, I think.
Okay. Then going back to the provisioning bit, of course, much has been asked, but just wanted to understand the understanding behind. So these are contingency provisions, right, which have been building over the last 2 quarters, of course, right direction. But this is against the BB and minus portfolio, I mean BB and below rated portfolio, or what portfolio this is being built against?
No, it is a contingency provision, looking at sort of risk markers across a very broad range of portfolios. And, as we said, the continuing uncertainties in the environment, both geopolitical and macroeconomic.
Okay, understood. And then just a small one on, can you talk about the revolver, percentage in the credit card portfolio that we may have, and also the EMI book?
We have not really spoken about a specific percentage, Rahul.
Okay. And then one final, big picture question. So RBI has been, RBI has put out this vision document on payments in which they talk about UPI, credit on UPI, plus linking the RuPay credit card to UPI. Any broad thoughts on how you all thinking about those, and does it sort of excite you about the credit on UPI, etc.?
So we are always sort of excited about new innovations that take place in the payment system or the financial system. And I think we will, participate in all of these, within our sort of risk appetite. We already offer, a pay later product, which is a credit line on UPI embedded in the sort of bank's mobile app. And I think, India has one of probably the most evolved payment system in the world, and we would keep looking at what business cases or use cases arise out of that.
Fair enough. That's very helpful in India. Thank you.
Thank you. The next question is from the line of Mahesh MB from Kotak Securities. Please go ahead.
Hey, hi. Just 2 questions. Anindya, how does the portfolio behave for the next, let's say, 2-3 quarters in terms of yields, given the recent increase in the repo rate in your portfolio?
So we have given the numbers, Mahesh. 43% of the book is linked to repo, 69% is linked to, about 6% is linked to other external benchmarks, and 21% is linked to MCLR. So our MCLR we have reset by 50 basis points at the end of May and June. Repo, as you know, has moved up by 90 basis points, and all these have, sort of 3 months to 1 year reset periodicity. So that will play out over the next few quarters.
Okay. And in your assessment that the ability for a full pass-through is visible in the portfolio, adjusted for the repayments and the fresh additions at the spreads, which might be different to what the portfolio is contracted at?
For example, if you look at the repo-linked portfolio, say the mortgage portfolio, there, as you know, the floating rate product that is uniform in India has a lengthening of the EMI schedule, up to a certain level, and there is only a smaller set of customers who would see an increase in the EMI. So, in the larger corporates, etc., I think they also have their own fair degree of resilience or, ability to kind of refinance and so on. So it should be manageable, but as I said, it depends upon the pace and extent of these changes. So we'll have to watch as we go along.
Okay. Second question, sir. CCOD changes on the NPL side. I didn't get this in case it was answered. Was there any impact of it in the current quarter?
So that was a clarification which came in Q4. I mean, there would have been, some impact, but nothing that, we have quantified for calling out in particular. I think we just have to adjust to it. There would have been some impact, and hopefully that impact will, trend down.
Okay. Thanks, Anindya. I'm done.
Thank you. Ladies and gentlemen, we take that as the last question for today. I now hand the conference over to the management for closing comments.
Thank you all very much for sparing time on a Saturday evening, and Abhinav and I will be happy to take your calls post this as well. Thank you.
Thank you.
Congratulations.
Ladies and gentlemen, on behalf of ICICI Bank, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.